Well, welcome back. Good Friday morning, everybody. Thanks so much for joining us this morning, and I hope you're having a good morning. I'm Maria Bartiromo, and it is Friday, February 6th. It is 8 a.m. on the button on the East Coast. Coming up this hour, in just moments from now, we will talk with the Chairman of the Securities and Exchange Commission. Paul Atkins will join me right here coming up. And then at 8:30, don't miss Kansas Senator Roger Marshall on deck, all ahead. Treasury Secretary Scott Bessent, meanwhile, is urging Congress to pass the Digital Asset Market Clarity Act, warning that all these delays are leaving crypto regulation in limbo. The bill remains stalled in the Senate on disputes over stablecoins and how digital tokens are defined. Meanwhile, a Senate panel has advanced a separate version that would place most non-security crypto assets under CFTC oversight. And a White House meeting this week aimed at breaking the legislative stalemate ended without a deal. Joining me right now is the Chairman of the Securities and Exchange Commission, Paul Atkins. Mr. Chairman, welcome back. Always a pleasure to see you.
It's great to see you too, Maria. Thank you for having me.
And I want to start right there on the crypto legislation. What was the holdup in terms of the markup on clarity? Because we've spoken with lots of people from Coinbase who had some issues with the way the rewards issue is being handled. From your standpoint, what right now is holding up this legislation?
Well, so I'm not involved in these discussions because, from my perspective, it's clear from the Genius Act, which was the first statute that has been enacted by the United States that clearly recognizes a crypto asset, and those are stable coins, and sets up how they are to be regulated and how they're to how they're created and all of that. So that was a great triumph, I think, back last year in mid-year, and when the president signed that into law. So that's great, and it clearly sets stablecoins aside and defines them not as securities. So that's not part of my remit. I'm focused on tokenized securities, and to try to make clarity on that. The United States has been really dilatory over the last many years now by not addressing these issues as between what's a security and what's a commodity. But we have now a huge opportunity. The president has appointed a former colleague of mine at the SEC, Mike, who was in my office, Mike Seelig, to be chairman of the CFTC. And so the two of us are proceeding apace to harmonize our rules and then to bring clarity through the rulemaking process as to what's a security and what's a commodity. And that will dovetail with what Congress is doing, and we really need to have a statute that undergirds our efforts on this harmonization side, because otherwise it's rulemaking that we have authority to do, but it's really necessary to have this ensconced in a statutory form.
Yes, and I thank you for that, because, of course, I really want to get your take on what the oversight should look like in terms of these digital assets and this new world that we're entering. We will talk with Kansas Senator Roger Marshall coming up in terms of the actual legislation on clarity and where that stands and the hang-up in the Senate. But, Mr. Chairman, talk to us a little about how things are changing and what kind of regulatory barriers we need in place. We did speak with your colleague, former colleague, and now the chairman of the CFTC this week, Michael Seelig, and he walked us through a little about the differences of commodities versus securities. And here's what he told us in terms of oversight there. Watch this.
For too long, we've had the Gary Genslers of the world regulating by enforcement, claiming that every digital asset is a security. And Chairman Paul Atkins and I really disagree with that view. We believe that most crypto assets in the markets today are commodities. These are digital assets that maybe were issued as part of a securities transaction, but they trade a lot like oil, gas, and other commodities in our markets. And the information that is prevalent to and important to trading these assets comes from the markets at large. It's not coming from a single source of information, as you see with the capital markets with an issuer. And so we need to build markets that allow for these assets to trade with clear rules of the road, and we can't regulate by enforcement anymore.
And Mr. Chairman, I think that's why the Genius Act was celebrated so much, because you did make a clear delineation of what is a commodity and what is a security. So talk to us about how we should look at that and what specific differences you have identified.
Yeah, well, so so the Genius Act was great. It focused on stable coins and put them squarely in the banking sector. So my good friend and controller of the currency, Jonathan Gould, is working diligently on coming up with that regulatory framework for stable coins. With respect to other sorts of things, I gave a speech a few months ago delineating what we are going to be working on and coming out with here shortly is a taxonomy, so-called, as to what are digital commodities versus tokenized securities, so we can give clarity to the marketplace as to what it is, and end, as Chairman Selig was talking about, end the regulation through enforcement that has so long bedeviled this whole area of financial services, even predating the whole crypto world and going back, to decades, as between what's in the CFTC realm, what's in the SEC's realm. So there are digital commodities and digital tools and digital collectibles that we have described and will be outlining in regulation. And then we have tokenized securities. So the first three clearly within the CFTC's rule remit, and then tokenized securities in the SEC's remit. So this is one of maybe the only time that a regulatory agency is voluntarily ceding clear jurisdiction to another regulatory agency. But again, we are out to harmonize the rules as between the SEC and the CFTC, giving clarity and certainty to the innovators and to investors in this particular area, so that people can develop their products in the United States rather than feel that they have to go offshore to do that. So if we can do this here in the United States under American law, I think that will be best for investors, best for the financial markets, and best for innovators, and help them save time and money.
Absolutely, and that's why Treasury Secretary Scott Bessent this week said, look, we need to get on board and get on the same team, otherwise this market moves to El Salvador. But, the idea of tokenized securities is really interesting to me, because I'm seeing tokenization ideas in basically every market. I mean, are we expecting all markets to ultimately be tokenized? And it appears that if you do have a slice of a security, a token, tokenizing markets, that it perhaps could open up the floodgates of more participation in the market, perhaps enabling smaller investors to get involved. So can you walk us through tokenization and what a token is in terms of a security?
Well, so a token basically is a smart contract, and by smart contract meaning it's a digital representation of an underlying asset. And so in the case of securities, which are traded now electronically for the most part, although some people still have stock certificates, paper certificates in their safe deposit box or wherever. So all of those are representations of a share of ownership in a company or some other sort of entity, mutual fund or whatnot. And so whether that's in paper form or on a computer resting at the Depository Trust and Clearing Corporation, or what's tokenized mean is it's on-chain, on a blockchain, where there the possibility whether you have stable coins, tokenized money market mutual funds, or tokenized bank deposits, the possibility of having an on-chain clearance and settlement of the transaction that is agreed to by the two parties, and then actually the clearance and settlement of that, to have that on-chain in an immediacy type of a T0 sort of environment potentially for many instruments. I think that's very exciting for the prospect of de-risking the financial services sector. For years and years, that gap between the transaction date and then the clearance and settlement date, when the money's exchanged and booked, and the two parties then are square as to the transaction. It used to be 5 days, 5 business days. Now we're at 1 T+1, 1 business day. If we get down to T0 for many instruments, that'll be just a huge positive change for the marketplace. So that's what excites me about this, and the investors will decide what's the most convenient. Is a stable coin how they want to affect their transaction? Do they want to use like a debit card, a bank deposit, a tokenized bank deposit that gets debited from their account immediately, or some other form of payment and delivery? So that's, I think, the prospect that is really exciting for the future, and we're at the cusp of that right now to be able to put that into effect.
Yeah, that's pretty incredible. So what specific rules or regulations are you envisioning in that space for tokenization? Is it the same regulation book that we have seen with regard to all securities? How does the regulatory framework change?
Well, basically, again, we're just migrating from, we already have enabled digital representation of the old-fashioned paper stock certificates. So that's one thing that has proven, really over the last, 40 years now or more, proven to be a real step forward, for financial services, for global trading, and that's helped to propel the marketplace in, I think, a very good way. Enabled growth and de-risking, as I was talking about earlier. And so now the next step, on-chain, on blockchain, using the distributed ledger technology that is what's behind, when we talk about the blockchain. That itself, I think, is the next step, and is, as I said, very exciting. We will be adjusting our rules, and those are tweaks, I would say, but at the ground, what we have to do is then give certainty to, again, what's a security, what's a commodity, and I don't want to have any more warring factions as between the two, fortresses of the SEC on one side, CFTC on the other, and a no man's land in between, where over the years so many products have just languished and then just never gotten anywhere out of that no man's land. So if we have harmonized rules from SEC and CFTC, mutual recognition, maybe what I've been talking about is having a super app type of concept where we have substituted compliance as between CFTC and the SEC, that will be an amazing environment then for people to not have to worry so much about where they are registered, but to have the certainty that they're in the United States under United States laws, and they can go forth and do their innovations, and then let investors in the marketplace decide what is the best way for that investor to interact with the marketplace for his own benefit.
And of course, you've got to add to the CFTC the agricultural department as well, right?
Exactly.
And why is the ag department so important here? What role does that have here?
Well, that's where the whole futures markets started, was back where farmers wanted to hedge their exposure to the weather or whatever else, and to the market itself. So that gave birth eventually in the 1970s to the Commodity Futures Trading Commission and to their rule book. And so they have a lot of rules that apply, to those markets. So that's great. And obviously, the securities markets have been around, for centuries. And so there are a lot of rules that have built up and practices over those centuries. So the two can coexist, should coexist, must coexist, because there's a lot of back and forth with traders, from the two markets. They're very intertwined, which is great. And that's part of the amazing aspect of modern financial markets. So we intend to support that, to help people innovate, and it's been too long for this uncertainty to weigh down on innovators. And there's so many possibilities. If the government can get its act together to actually talk to each other and collaborate and harmonize their rules. But that's what Chairman Seelig and I are out to do, and we can achieve that. And we can go forth under the authorities that we currently have, that Congress has given both of these agencies over the last several decades.
Well, it's so important. And in the middle of all of this great innovation and sort of new direction that we're talking about, you've got the prediction market also becoming a force. I was astounded at the range of business that Coinbase is pursuing. They want to do everything exchange. They want to do prediction markets. And you've got prediction market platform Kalshi reportedly seeking regulatory approval to allow margin trading on its platform. Mr. Chairman, what about the prediction markets? What can you tell us? And as these markets grow more complex, what are the rules of the road for prediction markets as well? What's your take on how significant we've seen the prediction markets become?
No, they've burgeoned, here of late over the last few years, and you can tell there's a hunger on the investor side and to participate in that sort of product. So, we need to obviously accommodate that. And there are other sorts of more traditional types of products that are similar. And so a lot of this is mostly in the realm of the Commodity Futures Trading Commission, but there are certain products that, whether they exist now or one can contemplate, that would be more related to securities. So an option-type product is what they might look like in the sense of traded option. So we will be working closely with the CFTC because, again, that market needs certainty. It doesn't do any good to have people trying to guess, where do I go to which regulator. So that's definitely on the agenda for us to address. It's very important, especially now where the market is relatively nascent, and that we can help then guide it and not have people waste time or have uncertainty crop up, as to where to go.
And Mr. Chairman, when we first spoke, when you first took on the role of chairman of the SEC, you told me that you were hoping to make it easier for U.S. companies to go public, and you were hoping to ensure that we were getting the business here in the United States rather than seeing IPOs go overseas. You made the point to note that today there were a lot fewer IPOs because of the regulatory burdens and other things in the United States than just, several years ago. Can you walk us through what you've been doing in terms of encouraging companies to go public and ensuring that huge piece of business stays in America?
Well, thank you, Maria. So you've been very involved in this too. We've talked about this on your show, and I've been up in New York at both the New York Stock Exchange and NASDAQ to roll out our plans for making IPOs great again and making public companies make it cool to be a public company again. So over the years, we have had a real marked decline in the number of publicly traded companies in the United States. Over the last 30 years, it's down, say, 40% or so. And that's as companies have either gone bankrupt or merged or whatever. It's in the normal course of things. But the pipeline of new companies coming into the markets has decreased. And that's because the private markets have really burgeoned. There's a lot of capital in private equity firms, venture capital firms, and others that's looking for a home and looking for good investments. So that's great. God bless them for that. But public markets are important to help set valuations and for a robust type of indication of what the value is at any time of different types of companies. So we have a three-pronged process to try to make it more attractive for people either to go IPO or to do perhaps direct listings, which is another possibility of a private company then entering the public markets at a very not so costly type of way. So we're looking at decreasing the regulatory burden, the whole apparatus of public reporting, which has deviated benefited so much from the centrality of focusing on materiality. What does a reasonable investor need to know in order to decide whether to buy, sell, or hold a security? Looking at litigation reform, for too long, the SEC has been hostile to companies having mandatory arbitration or loser pays types of frameworks for interactions with either their shareholders or others, but through bylaws that they may have. And then finally, looking at the weaponization over the last several years of the whole shareholder proposal process and the corporate governance aspects, where some states have taken steps to try to make that, maybe more rational, and so we want to be able to facilitate those sorts of choices that companies may have. So through those sorts of steps, I think that we'll be able to we're already seeing some take-up. There are more companies that are entering the public market, so I think that's great. And so, we will, throughout the next couple years, we'll be doing that here, and especially this year as America, achieves its 250th anniversary.
Wow, what a beautiful thing on our 250th birthday. And you've said in the past, capital formation is investor protection, and I like that. But of course, I always go to China when we talk as well, and I hope you're also zeroing in on the auditing of those Chinese companies that traded on our exchanges and continue to do so. Now, the SEC is stepping up its crackdown on cross-border fraud, targeting pump-and-dump schemes tied to foreign-based companies listed in U.S. markets, some with operations or ownership ties to China, using offshore entities to access U.S. markets. Mr. Chairman, what can you tell us about that? Because you've launched this new cross-border task force and authorized trading suspensions in certain suspect cases, right?
Right. Yeah. So, I'm happy to talk about that. But so far over the last, several weeks or months, we have been, monitoring. Obviously, we monitor all the time what's going on in the markets, but there's been a growing incidence of what we call ramping and dumping, where especially it's some East Asia, China-related companies where they're small, kind of penny stocks on NASDAQ, and here one recently, a company on the New York Stock Exchange, where there was indication of potential manipulative activity, where we stopped trading on those companies so that they could be investigated by the stock exchange and see whether there's any potential investor harm happening. The one recently here, just last week on the New York Stock Exchange, where we stopped trading on it, the company said, made a statement, we don't have any new information, new news that would explain a sudden real spike in the value of the company on the New York Stock Exchange. So that was, so we halted that, and the New York Stock Exchange is investigating it. So hopefully, we'll get to the bottom of that.
Well, that's good old-fashioned investigating that the SEC has done for decades, and I'm glad you're sticking to your knitting on that for sure, Mr. Chairman.
We're on it.
Even in this changing, innovative world. Always a pleasure, sir. Thanks very much.
Thank you, Maria. Great to be here.
Chairman Paul Atkins. We'll be right back.